Welcome, everybody, to another episode of the Investing with IBD podcast. It's Justin Nielsen here, your host, and it is August 28th, 2024, and we've got an earnings bonanza. Of course, everyone's waiting for Nvidia, and to help us kind of muddle through what's happening in the market, Nvidia earnings, and let's not forget, we've had some kind of shake and bakes in the market with the yen carry trade and what was going on with the Fed. So there's a lot to make sense of here, and who better than to do it than the ambassador on the floor of the exchange, Jay Woods, coming back to our show. He is, of course, the chief global strategist for Freedom Capital Markets. Great to have you back, Jay. How you doing?
I'm doing great. It is great to be back. You look a little different since the last time I saw you, clean shaven. But you know, anytime I can talk to you is always fun.
Well, yeah, a few people said that the beard, once I shaved it off, they were like, "Oh my gosh, it took 15 years off your look." So,
well, let me assure the podcast listeners, you look great. So don't worry.
Okay, perfect.
Yep.
Well, hey, coming from you, that means something. So, Jay, I mean, like, let's kind of unpack this. I mean, this month of August, I mean, it started out with a bang. I'm going to go ahead and put out the S&P 500, and we'll just get right into it. And just as a reminder for folks, I want everyone to kind of know that, you know, Jay is not any shrinking violet to the markets. I mean, you've been on the floor of the exchange for what, 3 or 4 decades?
Let's not go crazy.
Okay, we don't need to go decades.
Since 1992, I've been on the floor. I was a market maker until 2020. I pivoted to be more of a strategist after 2020. I've been with Freedom for 18 months. It's been an 18-month joyride. I enjoy every day coming to work, and I still have access to the floor, which you see in my virtual background right now. And that floor training has really made me, give a different perspective on markets than some of these regular strategists who I have great respect for. And as a technician, I put some of my experiences, a lot of the technicals to work. So I get excited on the short term, the near term, the intermediate term, and the long term. And time frame is very important. So when we're about to talk about the market, I'm going to do it in more of a longer intermediate term time frame. But yes, I miss the trading of second by second on the floor. But I bring my perspective to all different time frames. So when we talk, as the audience will soon learn, and those that know me already know, that I will look at things on multiple time frames and try to set people up from the best risk reward setups that we possibly see, and tell you what time frame I'm looking at.
Yeah, perfect. So we'll go ahead and start on the daily chart of the S&P 500 index here. And again, we started with this nice, what we were calling kind of like a follow-through day action on the S&P 500 that immediately failed. So what we call an expectation breaker to the negative side, and things just got kind of ugly pretty quickly. So when you see this kind of shock, and of course we have to put this in the context of the VIX too, a huge spike up in the VIX that I know you were kind of commenting on, you know, what does this mean when you have such a spike? And I'm going to throw up the monthly chart on the VIX, the CBOE Volatility Index. I mean, this was right up there. I was actually talking about this with Jim Ropel last week. This was right up there with the financial crisis and COVID. I mean, that's how extreme it was. So put this in context.
Let's talk about the month of August. My God, it's been one of the most volatile months of the year. August, September. We haven't had a stretch in the last 3 years where both months have been up. Right now, we're teetering on an even August, slightly down. So that streak may continue. But that day, August 5th, the VIX spiked to over 60. You are right. To put it in perspective, it was the third biggest day as far as spikes in the VIX go, bigger than 9/11. Now, I was there for 9/11. This shocks me that we didn't have that. Maybe it was because the market was closed for 4 days afterwards. I don't know. But when you see a spike in the VIX, that is extreme fear, extreme panic. And it doesn't just snap its fingers and go away. So one of the themes I've been talking about when I go make the rounds this week, this month, has been there will be aftershocks. And maybe we're about to experience one right now. Let's see how the market reacts on the opening tomorrow. We're taping this the night of Nvidia earnings. So I think that will play a big role in it. But I went back and I looked at the VIX historically and in election cycles, and in particular the last two. When the VIX has spiked it does tend to have aftershocks. We had a big spike in 2016. We had a spike in 2020, which was the big spike, COVID. And then we had spikes September of that month going into an election, and then the end of October or election day itself in one case, where there is panic, there is fear. The market is edgy right now. And what we've seen, if we want to look at the equal weight, we've seen a broadening out. The market is doing well. Money is not rushing for the exits. It's spinning around, but the indexes, the stocks, the sectors that matter, those Mag 7 stocks, they aren't leading right now. They are consolidating. They are taking a bit of a break. And what we need to see, and let's talk about Nvidia because it's on everyone's mind. In fact, if I got a nickel for every time they mentioned it today on financial news, on financial Twitter, I tweeted this out. I'd have Oprah money right now. It was ad nauseum, yet we're going to add to the talk of Nvidia. What I want to see in a stock that leads, and why do I say it leads? It's 6% of the S&P 500. It's 8% of the QQQs. It's 21% of the XLK, 21% of the SMH, Semiconductor Index. It's kind of an important stock. So yes, when people make a big deal of it, they're not wrong. But what you want to see is price action that can be the stock that takes us that next leg higher. Will it do so? You've got to watch how it closes. And we have precedent in Nvidia. Last August 2023, they had a blowout quarter. It was a great guy. Jensen Huang was doing victory laps. Pre-market, post-market, it traded up 40 from 480 to 520. All right, it opened at the NASDAQ at 930. At 501.20, it traded to 501.60, up a whole 40, 50 cents, and then it reversed. It lost momentum. What I want to see if momentum is going to be in the stock, if it does react well after the conference call, after the dust settles, after we open the stock. You got to watch two levels. And now it's split adjusted. So 135 and 140.70. 140.70, the intraday high, 135-ish and change, the all-time closing high. You want to see the stock set and close at new highs. If we do that, then that next leg of the bull market is confirmed. And this one stock is that important where I think, okay, throw everything out the window. We're going higher. What I've been calling for is consolidation. I'm seeing a double top. I'm seeing it in the Qs. I'm seeing it in the S&P 500. And yes, the Dow made new highs. The S&P 500 did not. We had a nice snapback rally from August 5th, but I still think there's a little angst in this market. And yes, we broadened out those sectors that are making new highs, and I can rattle all 5 off the top of my head, whether it's healthcare, industrials, financials. Now I'm cheating. I'm looking at my screen. Staples. And utilities, real estate, another 52-week high. That's 6 sectors. This is fantastic. The market is strong, but the leadership is not going to get us to that next leg higher. In fact, those 6 sectors I just mentioned could have natural pullbacks, give back a little bit, and we're still in uptrends. Everything's okay. But if these magnificent 7 stocks pull back, it's going to have a deeper impact on the market. And a 5% correction from the recent highs gives us the 5,200. We're making a higher low. If we do, I don't want to see us breach and test that August 5th low. That would give me a little bit of pause. But I think we consolidate. This is seasonally average. This is normal behavior. And then guess what? You look at the election cycle. I was looking at this. This will be in my newsletter next week. September and October are weak months going into an election. Guess where we're strongest? November, December. You look at 2016. You look at 2020. The lows, the near-term cyclical lows were on election day. Both controversial elections, both trended higher. I think the setup's there. The technicians have been spot on. And I went to an event, the Christmas party, the CMT Association, New York City chapter Christmas party, and Tom Lee spoke there to us. He was there with Mark Newton, who's one of the best CMTs out there, one of the best in the business. And Tom Lee said, in 2023, the technicians had it right. Well, guess what? 2024, the technicians have got it right. The cycles are playing to a T. You talk to people like Ryan Dietrich. You follow me. Everything has gone according to plan. We had 5% correction, a near 10% correction. These things happen on average. If we have a 5% correction between now and the election, that's not panic. These are normal cycles. The problem is when you live through an August 5th, you get the jitters. You get nervous. You're checking your portfolio. What August 5th gave us was a buying opportunity. The Japan yen trade, the unemployment number the Friday before, Warren Buffett sold some of his Apple stake. We had
Google
headlines.
antitrust.
Yeah, yes, yes, we had headlines to really accelerate it and cause that fear. I don't think the fear is out of this market. I think we're going to have some churn. And when you hear double top, that has negative connotations. To
Well,
me,
let me stop you real quick. Can you,
yeah, please.
you know, because I think a lot of our listeners are familiar with one of the patterns that we talk about a lot, the double bottom, right? Where you
Mm-hmm.
kind of have a one leg down, it kind of forms a little W. The second leg down kind of undercuts that first leg.
Yeah.
And then that can be a really powerful setup for a move higher. So could you describe what kind of levels you're looking at for the double top and what
Yeah.
that means exactly?
Exactly. Thank you. And I love to clarify these things and break it down into simplistic terms. A double top, just like a double bottom, is a pattern where you see, all right, in the double bottom, things have started to not go as low as they were. We had a retest, it succeeded, and we started going up. Then once you have that double bottom, you want to look, have we broken different downtrend lines to go higher? So what I'm looking for in this near-term double top is a consolidation phase. What I don't want to see is us breach those August 5th lows and create a new low on the way down. What I want to see is a chop zone where we go sideways. People don't realize this. I use this line a lot. Sideways is a direction. It's a constructive direction after a nice long uptrend like we've seen in the beginning of this year in the S&P 500, like we've seen in the NASDAQ and the Qs. We consolidate. It doesn't mean the rally's over. I think it's far from over. I think we're in a cyclical bull market. But when I tape this with you tonight, over the next few weeks time frame, I don't think we're going to get that catalyst to take us and break us out higher until we get to the election season, election cycle. And guess what? There are going to be some crazy headlines in this election. So don't get me wrong. We still have geopolitical concerns out there. So I don't think it's a crazy call to say we're going to see some spikes in the VIX, but we're not going to see anything like we saw on August 5th. That's for sure.
And just to kind of, you know, let people know, again, we're taping this Wednesday after the close. Nvidia earnings have come out. Looks like the stock is trading down about 5%. It looks like the earnings conference call. Oh, actually, it's only down 4% now. So it was down 5% earlier. The conference call is starting. Not really much that we can do in terms of, oh, let's do some, you know, live analysis. We got other things to talk about in terms of the general. Plus, maybe you could describe this a little bit since you were on the floor and you've been through your fair share of earnings cycles. You kind of saw when Regulation FD came out 20 years ago and what that did to the change in reaction to earnings. Can you describe a little bit about, as a market maker, how you were making those adjustments to the stock as all these analysts are putting these new numbers in, kind of coming up with different valuations? You know, how do you kind of come up with that number of, hey, here's where I'm going to open the stock up?
Yeah, well, that's the great thing about being on the floor in the market. It's 9:30 and 4 o'clock. The after hours are the Wild West. The pre-market is the Wild West. It can give you a direction, but it is so volatile because, one, there are less participants, and two, from New York Stock Exchange point of view, there's not that human market maker that has to participate as well. So you lose a major participant in that stock. Two, you are trading on every whim and every line of that conference call right now. So you're going to see this stock all over the place. It's down 5%. Then it was down 4%. It traded as low as 115. Now it's trading at 120. It was up initially after it released earnings. That to me is, if you want to be in front of your computer and watch second by second ticks, have at it. It's fun, but it's not where you're setting yourself up from the risk reward. So what I did was I had game plans when I got down to the floor. Where is it going to open? Where is it going to gap? Know my levels, and then trade from there. When I had a crowd back in the old days, I could judge it on the crowd. You saw the buyers and sellers in front of you, so you had an advantage knowing that. Now it's all algos, so you better know your levels because you don't have a human advantage. And I'm on the same playing field when I was a market maker for the last 5 to 10 years that everyone at the, playing the home game, if you will, at their computers, on their trading desk was. I reacted to price action just like everybody else. So that was the biggest change. But 9:30, 4 o'clock, I always stress, the opening price and the closing price are the most important. And that is what I've been saying. And I already said about Nvidia. Watch where this opens. Watch gaps. Gaps are very important. Does it gap and continue higher? Does it gap, continue lower? Does the gap fill? Where do we close? Do we make new highs? Do we fail? We test it. We don't get there. So these are the things I'm going to be watching. And I would set trades at various price points based on support and resistance levels. And yes, my sentiment right now is that the market has lost steam and Nvidia is not going to make new highs. I could be proven wrong by the time this airs. This conference call could go great, but that is my initial thesis, and that is what I was telling people that follow us at Freedom, what to expect in the earnings. And you know, if I'm wrong, then the stock breaks out, makes a new leg higher. The S&P 500 is joining it tomorrow. But, you know, being there at the floor, 9:30 to 4, that's where the heavy volume is. Those are the prices to me that count. When you're a fund manager, when you're judging ETFs, mutual funds, that closing price is the most important price. What happens after hours does not show up on our charts. When you punch up a chart and you show it to us right now, it's not going to show us what Nvidia is doing after hours. 9:30 to 4, those are the prices that pay. Those are the prices that matter to me. But to some of your audience, they trade after hours. God bless them. There's nothing wrong with it. It's fun. It's exhilarating when you're on the right side of things, but it's extremely volatile. You have to be careful.
Yeah. So I'd be remiss if I didn't just quickly kind of touch on and get your thoughts a little bit more on, you know, Jackson Hole. We had Jackson Hole last week. We haven't even touched on, yes, there's geopolitical, there's this, there's Nvidia earnings, and there's, and let's not even, I mean, gosh, it's not just Nvidia earnings, right? It's CrowdStrike, Okta. You've got a whole host of retail between Abercrombie and Fitch, Kohl's, Foot Locker, Birkenstock, Burlington. I mean, Pure Storage. I mean, the list goes on. It's I thought earnings season was winding down, and then I looked at today, and it's like, man, is this the most important earnings day ever, or what?
No, it's not the most important earnings. Every day is the most important day as a trader, and you're only as good as your last trade. But no, I mean, retail likes to come out at the end. Most of the S&P 500 have reported, 95% of it. So that's why, you know, it seems like it's over, but no, there's been some fun. If you had Chewy today, you had a fun ride there as well. There are some interesting stocks, and you want to follow all of them, but the ones they focus on are the ones that are going to move the market. So it has been exciting. We're not done. But what I saw, some of the retailers, you mentioned some of these names, Abercrombie and Fitch, what a run that stock has been on. Their earnings weren't bad. In fact, they guided higher. Fundamentally, everything was all right. Guess what? It didn't have enough to take it to that next leg higher. We gave back some. I'm trying to think off the cuff. What was the stock that just reported 2 days ago? Oh, I'm sorry. I'm ruining your podcast by not being
that's okay. I mean,
quick. Where Kava. That's the stock.
Oh, yeah, that was Friday.
Or no, Kava reported, and it went on another run up. And guess what happened? All right, fundamentals, they issued secondary. Insiders are selling it. Well, yeah, duh, they should be doing it. The stock has been on a tremendous run. So we're seeing stocks that have been on great runs lose a little steam. And we're seeing some of the beaten down names like a Nordstrom's, like a Kohl's. You know, they caught a little bit of a bid. They were up a little bit today. And that is the psychology I've been seeing consistently in this market, where it started July 1st, where we saw the Russell go on a run. It lasted 2.5, 3 weeks. And the beaten down names, they caught bids. People were reassessing their portfolios. They were looking for value, and they came to small caps, and they got a nice pop. And then it reversed at the end of July, and then August took everything back down with it. But now we follow one thing to segue back to what you started, the Fed. The Fed, it seems like a distant memory, that Jackson Hole meeting at this point in time. It's amazing how quickly you forget big events. But listen, he finally pivoted, but he didn't do anything to surprise the market. And Jay Powell, this is the one consistent thing about him. He is boring. He is telegraphed. And what did he do? He did not panic on August 5th when Jeremy Siegel, someone I respect, is saying we need an emergency rate cut. All right. I happen to be on a network at 5:30 in the morning. I didn't sleep the night before because now I'm studying about the Japanese yen carry trade, because I understand the basis of it. But when you're going on live television and Japan's down 15%, worst day since Black Friday, you get a little panicky. But what you have to do is put things in perspective. And this is my trading background. All right, let's take a deep breath. Let's put it in perspective. They're calling for an emergency rate cut because Japan's down 15%. We're about to correct maybe to down 10% in the S&P 500. Got to 9.75, I believe. That's when you have to take a deep breath, look at your charts, look at your levels, put these things in perspective, and guess what? If you bought on August 5th, if you bought that, all trends maintain their uptrend. We had a correction. You lived through it. It's nerve-wracking, but you can't cry fire in a crowded movie theater like some people did. And guess who didn't? Jay Powell. He let things happen. We had a nice little recovery, a very fast recovery. I did not anticipate it being that far that fast, but you can't predict V-bottoms. This wasn't a V-bottom. This was a snapback rally, and we're testing those highs, and we're pausing. So the Fed, Jerome Powell, he told us we're going to get a quarter. We should have gotten it last time. The Fed minutes revealed that it was a 50-50 coin flip. We could have gotten a cut at the July meeting. It didn't happen. 2 days later, unemployment came out. What that told me was these guys don't get the unemployment numbers ahead of time, because maybe if they saw 4.3 versus 4.1, they would have cut. So that was interesting, because you have all these conspiracy theorists that say, oh, these guys know the numbers. They know. Maybe they didn't. Didn't appear they knew it then. So his dual mandate is in play. Inflation trending. I think Jay Powell is a technician, because guess what? The trend, if you look at unemployment, is trending higher. That's not good. The trend in the CPI inflationary numbers, the PCE, trending lower. That's what they want. And when they see the trends, now they have to get ahead of it. He was a little late. He should have cut last time. Will he make up for it with a 50 basis point cut? I don't think so, because guess what we're going to do if he does it? Wait a second. That's a panic move.
Right.
So he does it gradually, granted late, and sees what happens. That to me is, him. I'll give him credit. I know he was late and he caused this problem to begin with. Don't get me started. But when he finally did raise rates, he telegraphed each one. The one time he had to raise rates 0.75 of a point on a Monday before the Wednesday meeting, guess what? He leaked casually to the Wall Street Journal, Nick Timrose, that, this is going to be bigger than we anticipated. So he did telegraph it. He just didn't get a chance to do it at one of his own settings because they were in a quiet period at the time. And right now, we'll get a cut. And guess what happens after cuts? We generally will trade higher. A year later, we will be higher. But I think it's a sell the news event. I think, the September headwinds will rule out, and we're not going to get that cut and then off to the races. But 2-3 months from now, watch how the Russell closes this year. The Russell is the one index, and people that follow me know I've been touting the Russell, and I've been so close, and it just doesn't go, and it frustrates me too. And I'll eat crow there that it hasn't happened. But the setups are there. It's making higher lows. It's slow. It's boring. But when it does go, we saw it last October 27th to December 23rd, 27%. We saw it at the end of June. In 3 weeks in July, it went up 15%. I'm telling you right now, it's going to make a run at those all-time highs, November 2021, and that is another 10-12% higher than where we are as we tape this. And let's see what happens when it tests those highs. Every other index has broken out, gone higher. We are seeing consistent earnings growth, so there is a catalyst there. And then people are going to look to rotate into stocks that have been lagging. They tried it for 2.5 weeks. It failed. I think they'll try it again as we hit into year-end and post-election.
Yeah. Well, we're going to take a break right now. And when we come back, we're going to get into a few more of these concepts. And again, really lean into the experience you've had as a floor trader to kind of make sense of what's going on in the market. Stay tuned. We'll be right back. We're back on the Investing with IBD podcast. Justin Nielsen here, along with my special guest this week. It's Jay Woods coming back to the show. He is, of course, the chief strategist over at Freedom Capital Markets. And again, he's been on the floor of the exchange for a long time. You can see that for those of you watching the video, you can see his nice little virtual background. And just as a reminder, investors.com/podcast, you can get that video. You can see it on YouTube, subscribe to investors.com channel, like, subscribe, do all those things, because that certainly helps us put out more content. Speaking of content, Jay, I want to, before we kind of get into some of these lessons here, you've got a newsletter that you put out. I mean, in prepping here, I was looking at your newsletter. Can you share with folks, how they might get that newsletter and kind of get your
Yeah.
insight?
Oh, yeah. Great. Yeah. Every Monday in your inbox at 7:30, you'll get my thoughts on what we're watching for the week ahead. Obviously this week we talked about Nvidia earnings, different levels. We're watching the S&P. We focus on 3 stocks that are not Nvidia that we want to watch. Ulta Beauty, CrowdStrike being 2 of them, Salesforce the third. And it's just a good, quick, easy way to get a realistic and simplistic view of what traders on the floor are watching. It's called The View from the Floor. You can go to freedomcapitalmarkets.com and then newsletter and find it, or better yet, go to my Twitter handle. It's my name, jwoods3, and it is the first tweet, the pinned tweet you see there, and you can click on the Freedom logo and you can sign up. And it doesn't cost anything, and it's a labor of love, and the feedback we've gotten from it has been positive. It's just a quick, easy way to look at what we're watching here on the floor and what strategists all over the place will be focused on over the coming week.
Yeah, perfect. And it's so great again when someone has that love of the game to again share their thoughts on a regular basis. And I know you put a lot of work into that. So let's talk a little bit about those levels, though.
Yeah.
I mean, you are a lot of times putting yourself out there, and you're saying, hey, this is my expectation. These are the levels that I'm expecting it to hit, or this is what I'm expecting to do based on history, based on your, I'm going to say years instead of decades. I'm not going to call you out.
Thank you. Thank you.
So, based on your experience, but I mean, let's face it, the market is going to do what it's going to do. It doesn't really care what you think. So how do you make those adjustments? Like when new data comes out and it's like, oh, you know what? I was a little wrong on this. How do you make those adjustments? How quickly? Or, do you let it kind of touch those levels before you, and maybe wiggle around there for a little bit before you completely throw out your thesis? How do you know when you're wrong?
This is where I've learned from some of the greats. Being on the floor with the gentleman, Mr. Cashin, Art Cashin, who's a legend. He had a newsletter that came out every day, and he always ended it be nimble and always be ready to pivot because you don't know what the next day is going to bring. And that's the greatest thing about working in finance. If someone ever comes on your show and says, "I've seen it all," click it off, end the podcast right then and there, because that's what's great about what we do. We don't know what the next day is going to bring. I didn't know about the Japan yen trade going to cause the 3rd highest spike in the VIX back at the end of July. I would have been a genius if I called for that. You don't know, so you always have to be adaptable. And when I am now in this analyst role, which I've done for 3 years, I'm coming from a trading perspective. And as a trader, anyone in your audience, day trader, swing trader, long-term trader, when you buy a stock, and this is a horrible way to look at things, but I always think worst case scenario. When I'm on TV and I'm analyzing a stock, when I'm talking to you and we're going to go through 3 stocks later, I'm going to set them up from a risk-reward perspective. And I like to pick stocks where my reward is far greater than my risk. And all right, if this doesn't work, I got to pivot. All right, I'm calling for a double top in the S&P over the near term. Guess what? I told you if Nvidia takes us that next leg higher, all bets are off. But I put into my process what factors are going to outweigh others. In this case, I look at seasonals. I look at momentum slowing down in these big names. I look at the S&P equal weight doing great. So the market in itself is okay. But when people talk the market, they're not talking equal weight. They're talking large cap S&P. They're talking the Qs and the SPYs, the Dow, the Russell on the small cap level. So I want to make sure that when I tell a story, the audience knows, one, there are risks involved. I'm not some pundit that's getting everything right. It's been very good to be bullish over the last 18 months since I've joined Freedom, and that has been a feather in my cap. I've been bullish. I still am bullish. But if you listen to the first few minutes of this podcast, I don't sound overly bullish. Over the near term, I'm not. But I think you're getting buying opportunities. Know what levels you want to get in. If Nvidia closes, test 100, goes below it, I'd be extremely nervous, but I don't think it's going to do that. I think it's going to consolidate and give you an opportunity. So risk-reward parameters are the most important. I want to tell a story where the risk is not better than the reward, so the long-term, short-term investor knows what they're getting into, and I'll break that down when we look at some of the stocks a little later in the program.
So, on that risk side, I guess, sometimes, again, you can you can almost hold two different thoughts in your mind, right? That long-term bullishness, maybe short-term little weakness, pullback. So I mean, we started this whole podcast about the whole volatility and the potential for aftershocks.
Yep.
So I guess what kind of tolerance, when people are kind of coming up with these levels, or you're coming up with these levels for yourself, what kind of tolerance for volatility do you have to have? And, again, if it's something where you're putting your stop too tight, you're more likely to get shaken out in just a normal, pullback. But if you make it too loose, then, that risk reward ratio starts getting out of whack. There's too much risk for the amount of reward that is potential. So how do you find the balance?
Yeah, so as someone that was a professional day trader for years on the floor, stops were the most important thing, and timing and putting them in the right place, that was something you would learn over time. You had to know what your downside risk was, and sometimes I'd put my stops too low. Okay, the stock just broke out, was trading 5 cents a dime, 5 cents a dime. A buy stop at 11. I would rather use buy stops to get into a stock, because that's where the momentum, to me, is where you want. But once I'm in that position, say I buy a stock at 11 or 12 cents, on a short-term basis, if it breaks the figure, so I go 98 cents on my stop and it gets there, it hits, I'm out, I limited my loss. And what you try not to do, and come on, I'm guilty as charged, you try not to look back. You have a trade idea, you go with it, it failed, you move on. There are so many, 6,000 different stocks and ETFs you can trade from. Don't get married to one, but stay with your idea, have a plan, stick to it. Try not to second guess yourself. It's the hardest thing. And if you're going to second guess yourself, the best thing to do is say, oh my God, I gave that stock away. Because you know how many stocks I bought and I was right and it reached my target, which was my goal. And I said, all right, I'm selling. I got 10% in this stock. Let's move on. Well, that stock is off to the races. True story. I bought the Google IPO back in the late 99 was it? I've lost track.
Google was, I think, 2004.
Yeah. You're right. It was true because they just had their 20th anniversary. So, yeah, 2004. And it was that Dutch auction, if you recall.
Yes,
and I bought it. I believe it was around 95. I had a $100 limit, and I bought
everyone using Google to find out what is a Dutch auction.
Yeah. How'd that work out? Have we had any Dutch auctions since? I think maybe one or two. There was one notable one, but my memory's getting fuzzy. So the point was, I bought it. I had a goal in mind. This stock is going to be hot. It's going to run. I'm going to get out. It got to 150. I made 50% in a matter of a couple months. I got out. Do I wish I held it? Yeah, $10,000 at Google at the IPO. You see these metrics all the time. I would be on a beach in Hawaii, getting ready to go to the UCLA game next week if I was, smart enough. But my time frame, my goal was what it was. Now, I've been blessed that I bought Google, put it away in a 529 plan, not the amount that I once had. But know your time horizon. There are stocks, and let's talk about Nvidia. I'm on record. You can search on Bloomberg and Benzinga that I said, don't worry about this earnings period. If you're a long-term investor, you buy it, you put away. Fundamentally, that is the strongest stock in the world. When most of the Mag 7 are your biggest customers, when the demand is still there, when you have the growth in the industry, you listen to a Dan Ives, who's a friend of mine, and I bounce things off of him all the time. I am in the believer that AI is secular growth. We're in a secular bull market, and we're going to see a run over time. Did you miss the brunt of it? Maybe, but over time, if you're looking for a long-term idea, I can't think of many better than Nvidia right now. So long-term investor, I talk about how I'm worried there's a double top. It's not going to close at a new high, but long-term, you buy it, you put it away, you don't look at it. My 401k, I look at 2 times a year. I don't want to look at it. And this is when you know things are euphoric. When you start looking at that 401k, more often than you don't, oh, wait, this is getting too good. We're near a top. And that despair, when you think it's the end of the world, that's when you buy. I'll never forget the financial crisis. I sold stock, as it was happening. I liquidated. I was nervous. I was still mostly in stock. I mostly rode it the way down. But I was able to raise cash. And there was a day where it was the end of the world. This is it. Right. I think we traded 666 in the S&P 500. That's
exactly right.
That Haynes bottom. As we were approaching that, I didn't call the bottom. I didn't get there. But I was putting money into the kids' 529 plans. I said, basically, if this is the end of the world, if you think the world is coming to an end, you know what? My money won't matter. It's an old Art Cashin expression. He talks about the Cuban Missile Crisis. He goes back a little farther than we do, obviously. But, he was a young clerk, and there were rumors that there were missiles from Cuba coming to the United States, and he got sell orders, and someone stopped him. He goes, no, kid. You buy when the missiles are in the air, because if it hits, if it destroys us, what's it matter? So long term, those are opportunities. But short term, to get back to your point, you want to set up, because I don't know who's listening. I don't know what their time frame is. I don't know what your audience's time frame is. And guess what? You have 100 different listeners. You probably have 100 different time frames. You have to make the trade your own. And do it. And I tell this story all the time. I don't know if you have time to get into it, but my son, a 14-year-old at the time, he's now 19, he's in college, and he's into finance. He was sitting around Thanksgiving, and he said, Dad, I want to buy a stock. I'm like, oh, this is great. My son likes what I'm doing. He bought Tesla. So those that know me know this story. Those that don't, you're going to be entertained. Those that do, you can fast forward through this. But he bought one share of Tesla, and it changed. It was the perfect example of someone going from euphoria to despair, and I got to chronicle the whole thing. I blogged about it. I live tweeted it as it was happening. He bought it on a day of a secondary. It opened down 70 points. He bought it like 730, one share, and the goal was you keep the profits, and we'll talk about your losses, because he didn't think he could lose money, because that's how kids thought. Right. It opened at 730, closed at 800 the day he bought it. He was up $70. He started getting giddy. Hey, I'm the stock man now. You know nothing, old man. So I'm like, you know what? Screw you. I can say that on this show. I'm going to embarrass you. I'm going to make an example. Let's follow this Tesla kid in this story. And this was December, November before COVID. And it ran up. The stock went to 1,200. I go, Kevin, what is your game plan now? What are you going to do? You're up $500 in this stock. Sell it right now. I'm giving you a check for $500. Not even going to explain taxes to you. I'll take the hit there. Right. And he's like, no. I go, what is your goal? Basic 101. You bought a stock. What is your goal? He goes, it's going to 100,000. That's when, I threw my hat in the air. I'm like, all right, you're on your own here, kid. Good luck. I hope you're right. I think Kathy Wood may have been calling for it at the time. So who knows? And then all of a sudden COVID happened, and it started reversing. And his euphoric tweets got less and less. And then all of a sudden, it's now under 1,000. His profit is less than $200. He's like, I go, what do you want to do? He goes, I don't know. What should I do? Whoa, whoa, whoa. This was your trade. You own the trade. I can give you advice. And I didn't even give him advice on this one. I advised maybe you sell. What do you do? And all of a sudden, he went from euphoria to despair. He sold out for a $20 gain. And it was a good sale, because COVID hit in March 18th, 2020. That was the low. And here's the part of the story that I still don't, live down to this day. And in fact, if he's listening to this, he's probably yelling at me through the podcast, through YouTube, saying, on March 18th, I'm on the floor of the New York Stock Exchange. I'm in the middle of COVID. I'm getting my butt kicked. Everything's selling off. That was the day where hell was coming. If you remember Ackman going on CNBC in the middle of the day, we had a limit down during the middle of the day. Right. Our limit up, limit down, circuit breakers that paused the market, a 7% decline in the S&P 500. They happened 4 times. 3 were right after the opening. We knew we were going to be down 7%. All right. 1 happened in the middle of the day. That was Ackman Day. That was March 18th. And Kevin, during that day, he texted me in the middle of class in high school, it's time to get back in. God bless that kid. But, man, did he irk me, because I'm too big. I'm like, I don't have time for this. He goes, not only can we get back in, it's trading at 380, we can buy 5 shares. The kid was on to something. I threw the phone on my terminal. I can't be on the phone while I'm trading on the New York Stock Exchange anyway. And I didn't buy the stock. The kid missed the low by $5, nailed it within an hour, and it proceeded to go through the roof. It had a stock split since, and those 5 shares would have been, well, yeah, he would have made something like $5,000. I don't want to know. He'll remind me later, but it was a perfect example of somebody not being able to make the trade their own, living through a high, living through a low, and then turning to somebody like, some people, like, they'll blame it Jim Cramer. Oh, you got me into this trade and now I'm losing money. All right, well, let's revisit it. What happened during that trade? Now, I try to step by step saying, this is your risk, this is your reward. What is your goal? Make the trade your own. But everyone has different time frames. Kevin time frame was it's going to 100,000. Now I want to get out. And shame on me. I didn't buy him 5 shares when it was under $400, and we missed that boat. And I'll never live it down. But to
how dare you work for a living?
Yeah, I know, right? I mean, I had a crowd. There was actually, like, during COVID, we had pockets of crowds. There are humans down there. They are important. And I didn't step up like the kid said, and he was the stock man again. But the journey chronicling somebody's euphoria to despair was real life. It was right out of Jesse Livermore. It was unbelievable to live it, to be part of that. And then that story, believe it or not, it inspired me because I do a lot of financial literacy. I talk to students. I give a lot of tours of the exchange to educational groups. It helped me pivot in this career because friends of mine like a Josh Brown, like a Ramp Capital, they followed that and they told me it was good. And I blogged a little bit more. I got to write. And then eventually when my time came as a market maker to pivot away, I joined the retail side and I monitored risk on a trading desk. I talked to clients. And now I talk about the market. And as you can tell, hopefully it comes through in these podcasts. I have a passion for this. Absolutely. And I love hearing people's stories. I love telling stories. And when I can educate people or listen to a sad bar story over a beer about, oh, my God, I had this stock, I gave it away. Or, you know what? I have Nvidia and I bought it and I never looked back. Here's a funny story for you. In 2019, my father, he heard me talk on, somewhere about how I liked the Nvidia. And, he put $3,000 into it in 2019. About a few months ago, he calls me up, Jay, it's having a stock split. What's this 10-for-1 stock split mean? I'm like, oh, my God, you still have this stock? Right. Never sold it. I go, you had a 4-for-1 before this 10-for-1. And I think I walked you through that. I forgot about this. Did you ever sell? I sold the initial $3,000 worth like you told me to, but I'm holding on to the rest. Well, he has something like 800 shares. I don't even know. But he's one of those people, you hear the story that you bought a stock, you put it away, and it's paying big dividends. So, those things are great. But I never had the fortuitous to hold on to a stock, put it away, except if it's in my 401k. And that I try to take a basket. I try to be safer about it. I do miss trading day by day, but in this role, I look for opportunities. I like to share those with people. Yes, occasionally I will buy and sell stocks, but I have rules where I have to hold it. And yes, it's frustrating. So I focus on looking at stocks and talking the market and let other people trade. And I promise you, when I retire from this job, I will hopefully sit somewhere comfortable, some nice setting, nice background, maybe outside with a pond and a fish tank in front of me. Like I know Justin has one. I just heard this in the break, just to talk about the crowd. And, trade on my own and get back to what I love more than anything, which is trading. But right now, talking about the market, trying to drop knowledge, using experience that I have. And guess what? I'm always learning. But when I talk about things, and let's get to that next segment soon, I will put it in risk-reward setups. And so my audience knows what I'm looking for. And I think that's only fair. And when I'm wrong, come at me. That's fine. I've been wrong in the past, and I don't back down from my calls, and I won't go over the top. Yeah, but I gave you this one, this. I don't remember. All right. I just know that when I set it up, I'm setting it up for you to make the trade your own and for you to do well and, manage risk the best way you can, because managing risk is job number 1, job number 2, job number 3. I talked about it the first time I was on your podcast, 3 most important jobs on Wall Street. And then I said the 4th one, which is still true, lunch. Lunch is the 4th most important thing outside of managing risk.
Well, it's funny you say that because, I think a lot of people don't realize, they forget that, at the end of the day, there's kind of odds to this. I liken it to a poker game, right? And I love Annie Duke's book, Thinking in Bets, because it's so great to kind of, we had Mark Minervini on our IBD live show today. And, he was saying, look, if you got pocket aces, you're going to want to play those. It's not always going to work. You're not always going to win, but that doesn't mean the next time you have pocket aces that you shy away from it. It's still pocket aces, the best hand you can start with. So
yeah, and I hate to simplify what we do because it is complex and you can look at so many different things, but you try to keep it simple, and it is math. And when it's your money, you know what you can afford to lose and you know what you hope to make. And you want to do it over the long term, compound. I talk to youth groups. I have a son that's in the workforce now. He's 23 years old, and we went through his pension and his 401k and how he just wants to buy the index at first. You know, dabble in a few stocks. I think it's fun. And this is Jim Cramer's whole premise about mad money. Yes, it's taking turns, but he always says, and I'm a big believer in this, your first $10,000 you save, you put in the index fund because you want to be the index. Everyone wants to beat the index. Hell, be the index. The index is up on average almost 10% in the last 20 years.
And so many hedge fund managers can't beat the index.
You can't, and compounding is the best friend in the world. But that's boring. No one wants to hear a show about just put your money away and do nothing. They want ideas, so I think we should give them some.
Yeah. Okay, well, we're going to do that in the next segment, so stay tuned. We'll be right back. Welcome back to the Investing with IBD podcast. Justin Nielsen here. Also, a quick reminder for those of you that have been listening to this, make sure you go to thatinvestors.com/podcast. You can like and subscribe. Find it on your podcast of choice. So we would really appreciate that. But let me also remind everyone, our special guest this week is Jay Woods, coming back to us from Freedom Capital Markets. He is a chief market strategist there. So Jay, we talked a little bit about, and I think it's a great story because it really just kind of illustrates the emotion that a lot of people can go through. And I find for myself, sometimes the risk part is easier because it's like, oh, here's a level that kind of makes sense. If it comes down to this level and goes through it, it's going to look broken to me. I'm going to lose my interest in it. I've got to, keep my loss small. But the reward side, that's sometimes a little bit harder. It's really easy to get caught up with the story. I mean, like AI right now, it's such a powerful story, and like what might be possible. It kind of makes your imagination go wild of what a stock could do, just like your son thinking Tesla could go to 100,000. So how do you kind of set your levels on the reward side that are reasonable and based on maybe more facts than fiction?
Yeah, I'm more conservative. So if I start seeing a stock go in my direction, I play a breakout right or a turnaround right, I will leg out of the trade because I don't want to lose the whole trade. So I'll sell a quarter at a certain level, a quarter at another level. And then, I was blessed that I traded the meme stocks and I gave those away, but I hit AMC, I hit GameStop at times, but I was up $2, I was up $4, I was up $6. I'm taking the money and I'm running. I'm not in this mindset that this thing is going to go on forever when I have an idea and a goal in mind. Now, those long-term ones, I will look at every quarter. You look at those every quarter, those Magnificent Seven stocks. I am not trading Amazon. I am long Amazon. I put that away. I'm long Walmart. I put that away. These are great companies that I think over the long term will do well. But when I bring ideas and we'll go through those, I would like to get out at various levels because I'm in a trade to make money. So I want to lock in profits. And like I said, let the worst problem you have in life is saying, I gave this stock away. Guess what? You still made money. You still did better than putting in a savings account. You're doing all right. But the psychology that goes along with it, you can beat yourself up. But my God, if you're wrong and you don't limit your loss, you may not be able to recover from that. So those are the things I look at, and it's not a fun existence. I wish I could YOLO more trades and roll the dice. But when you say something like roll the dice, now you're talking in gambling terms.
Yeah.
I don't like to use the word double down when a stock goes against me and I buy more to cost average down, which is the right terminology. Because when I leg into a trade, I don't want to just put my whole investment into one thing at one time. Just in case I'm wrong and I like the longer term prospects of this company. I'll buy stock at 72, at 71, and a little more at 70. And now I've averaged in. And if something changes, I stop myself out at say 68. Am I happy about it? No, but I'm managing risk. I have some of my capital back and I learned to trade again. So once again, risk reward parameters there, leg out, take some profit, take some off the table, and let that last third, let that last quarter of your trade ride for as long as you want. God bless. But I am not going to buy 1,000 shares of Nvidia and still have 1,000 shares after a run like we've seen up 150% year to date coming into the day after earnings. So I will take profits when there are profits to be taken, and I'll limit losses. And, you know, in my career, it's proven all right. Am I retired living on a beach? No, I am not. But I have been successful, and it's, you know, law of averages, law of bets, if you will, to quote the book. And you want to make sure that that setup is favorable. And when it goes your way, don't look a gift horse in the mouth. Take some profits. It's okay.
Yeah, absolutely. Let's get into some stocks, and we can go ahead and start with Pfizer, ticker symbol PFE. Now, it's interesting. So here's the daily chart going back about a year. You know, this has been in a downtrend. It's below its 200-day moving average line for, you know, most of the last 12 months, but now it's gotten above it again. And it does feel like some of these stocks that did so well in COVID have kind of gotten a little bit of a resurgence. So now it's established itself back above its 200-day moving average line, right around its 50-day moving average line. That's this red line right here. So what is it that looks interesting about this stock?
Yeah, I'm coming in really boring. I apologize. People, Pfizer, they're like, what are we? Pfizer. Yeah, and you were kind. It's been in a downtrend. It's been an absolute dog. All right. COVID ended. It ended. That's what happened. And the downtrend, but let's look at it. It was going down for a significant period of time, and it stopped. Something has changed. So you want to look at it at multiple time frames. You want to look at it at a longer term. This is a longer term trade where you do have risk reward. We're making a series. Let's go over a year, a series of higher lows. It's slowly going up. It looked like it was really breaking out over 30. It failed, but the trend, the near term uptrend is intact. It's trading above its 200-day moving average, its 50-day moving average. These, to me, are barometers. From my friend Brian Shannon loves levels of interest. I look at barometers of health. The stock is healthier than it's been. Those trend lines, those moving averages are lifting up. This is what you want to see in a bottoming process. It's not going to be a V bottom. It's not going to go back to its old highs anytime soon. If it does, God bless. If you held on to it to that, then you weren't listening to me, because I think this stock can go to 35 to 40 over the next 6 to 12 months. There is a change. The healthcare sector has been acting great. This is a laggard, but there's opportunity. And what we've seen over pockets of this market, the beginning of the third quarter, beginning of July, we saw some of the dogs catch bids. The opportunity is there. Then when you back it out over 5 years, you see, wait a second, this has got a lot to reverse. So there's good upside potential. Now, I would look at that rolling green line, that $40 level, the weekly moving average, as resistance. So there are going to be stumbles along the way. It's Pfizer. It's boring. I'm not giving you a tech stock that's going to double over the next 2 weeks. I don't have one in my arsenal. Sorry. You know, I can leave and not do the next two stocks if that's what you were looking for. But what we see is a stock that pays a dividend of 5.8%. That's not bad. That's better than putting your money in the bank. And it's starting to trend up. So the risk reward, that's what we look at. The setup is favorable. You wait for this. You have your nice dividend to cozy up to, keep you warm at night. And then if it breaks these 200-day moving averages, I would use the lows in June as one of my first stops. If it breaches that, then I would get out. I would reassess, and I would go somewhere a little more sexy. But I think this is a great setup over the long term from a risk reward point of view, has something to reverse, and it pays a nice little dividend. And then the story, yes, COVID is over. They made a great acquisition in December, and I'm blanking on the name, of course, as we saw, but they have done a lot of things behind the scenes to get that pipeline coming. And it's ironic because COVID is back again, but, you know, people aren't rushing out to get the vaccines like they used to. And this stock, to me, fundamentally, technically, it's great from that risk-reward standpoint.
Yeah, great. So another stock that, again, a lot of people might be like, wait a minute, this is containers packaging. You know, how sexy is that? But I mean, this is in a much more solid uptrend. I mean, this has been trending above its 200-day moving average line, above its 50-day moving average line. This is a little bit long-term chart on the weekly. This looks like it's getting close to all-time highs.
This is my favorite setup in the world. This is a beautiful rounded bottom, and this is us anticipating a move. All right. You can say right now as a technician, this is resistance. This is probably where I would get out. I would wait for the breakout to get involved. Smart move. Wait for the breakout, wait for price to confirm, and then leg into the trade. Makes sense. The stock's up 22% year to date. It's in a sector that's been wishy-washy. PKG has been the best performing stock, packaging in the sector. It's up 44%. Next best to me is Aptar Group. They make nasal sprays. They make containers for cosmetics. This is not what you think of when you're like, oh, this is high growth area, but it's a useful area. It's a stock that has had a run in the past. It's come back and it's gone full circle. And what is it forming right now? A nice rounded bottom, a little cup and saucer handle there at the end. On a yearly basis, it just broke out. It broke out literally over the last 2 days. That's why it's on my radar. It's got to get to 160. That's another $8 from here. That's not a bad little start before it really tests that ultimate breakout on the all-time basis. But to me, the momentum is there. The setup is there from a risk-reward point of view. And if it does continue this breakout, let's see what happens at 160. Maybe you sell a third of the trade at 160 and you see if we can make that breakout, make that all-time new high. It's in the mid-cap 400, so it's not one of your Russell stocks. It's that next step up. But it's a great company that's done well over time. It had a rough 2022. It's finally coming back. And the momentum, the trends, they're slow, they're steady. Once again, boring, but up 22% year to date. I think it can have a nice follow through. And if we get that breakout, we've gone through earnings season. We don't have earnings until late October again. But I think the setup is there for this to probably leg up to 160 to that October earnings period. And hopefully that will be the catalyst. And here's a fun fact for you. It's up the last 8 earnings periods in a row after earnings. It's not a bad streak. Let's hope it continues.
Yeah. And I apologize to folks because when I initially was putting this on the weekly chart, I'm like, this looks a lot more volatile than I was expecting. And I had the wrong scale on. So I changed the scale to our standard scale. I had it on our best fit for some of those that we were looking at before with big moves. But this has only been, it looked a lot worse. This has only been a 9% correction in this last flat base. So when you're talking about, okay, if this comes all the way down to the bottom of the base, that's a 9%, so it's not risking too much to get at the bottom of the base. It looked a lot worse when I had it on the best fit scale. So we'll go ahead and also close this out with and let's talk real quick because there are some of these stocks that you actually were the market maker for. So you've got a little extra kind of, oh yeah, I know this stock. And so Matson, ticker symbol MATX, is among those, if I'm not mistaken.
Yeah, I was a proud market maker in that. The Aptar Group for a little while, ICE, Intercontinental Exchange. These are the Generac. These are stocks that I knew inside and out, and I traded minute by minute. But now when I back it out, I look at them knowing, how good the companies are behind the scenes and seeing the chart setups. To me, Matson is my favorite setup in the world. It's already had that rounded bottom breakout on a longer-term chart. And what is it doing again on a one-year chart? It has a rounded bottom. It broke out, cup and handle pattern with a breakout, little momentum. It's in the transportation sector. It's not Kirby, KEX, which was also a stock my firm made a market in. That stock's up 53% for the year. But the two shippers, Kirby and Matson, I think Matson's going to play some catch up to Kirby. Both stocks have been tremendous in uptrends. Matson, near and dear to your heart, big Hawaii fan. You are, Justin, based down in Honolulu as well. The stock is looking tremendous. The transports, when you want to look at the index itself, the transport's been consolidating a lot lately. Matson and Kirby have helped them to the upside, but I think the transports are on the verge of a breakout. Let's get past election season. Maybe that's when it goes. Maybe it goes sooner. But to me, the risk-reward setup is there. The pattern is my favorite. We saw this last time I was on your show. We talked about HCA Healthcare, similar pattern. We called that one. The other two I called are up small. Nothing that I'm going to pat my back on, but what I see technically, what we've seen from the shippers fundamentally, they've been knocking it out of the park lately. The strong demand is there. Hurricane season doesn't affect the Pacific corridor like it does the Atlantic corridor, and that's more cruise lines, and that's short term. So Madsen to me is a stock that is set up to slowly move. In over a year, it's actually coiling a little bit, and it's starting to break out of that coil. So this, to me, slow, steady, nice progression. You may get a run here or there, but it's boring. It moves like a tanker. And to me, if you want something that's boring in a nice uptrend and has a good risk-reward setup, I give you Madsen. It's in the transportation index. It's been there for a long time, but the shippers don't ever seem to get any love. And it's not going to be, oh, today earnings, we're watching Kirby and Madsen. Unfortunately, there are some great stocks that don't get a lot of attention. And so if I can bring some attention to it, to your investors to take a look at this, look where it's come from, look where it could possibly go. I think the setup is there to be an addition to your portfolio that won't be something you're going to want to watch every day, but over the long term, the setup is there from, yet again, a risk reward point of view. And if it does break out of the breakdown from this base, then maybe you take a little bit of a loss. But I think the setup is there for the next 6 to 12 months. That's my time frame to continue on this uptrend.
Yeah. Now, to kind of close this out, because again, these are some what you kind of call more boring stocks.
Yeah.
But you kind of said at the outset, look, some of the, if you just take the 11 sector spider ETFs, some of the ones that look the most interesting are those boring ones, the XLU utilities, the XLP consumer staples, XLI industrials. So how do you kind of make your, I guess, outsized bets in certain areas, or are you doing more of, okay, I'm gonna spread it out a little bit, just a little bit in tech and a little bit in these more boring areas, so that your overall portfolio is a little bit more balanced? Not all high octane, but not all slow pokey, so you're like not outperforming the index.
Yeah, I don't YOLO tech stocks or Magnificent Seven stocks, and if I did, I would have some great runs, but the volatility is just a little too much. And what we're seeing is that broadening out is the strength in some of these. So what I do is the top-down approach. I'll look at the industrial sector, what's moving the industrial sector. I see GE very involved. That's also in the defense sector. I like ITA, the defense sector right now. General Electric, a big part of that. There's a stock that they split up, and it's had great ramifications for it. Like AT&T back in the day. Kellanova had a split. It did well. People talk about Alphabet, which I call Google, possibly splitting, and they're like, oh, no, actually, that could be great. Some of the parts would be greater than the whole. We see it in GE, and that is what I do. I look at the indexes, which ones are breaking out. Where's the strength coming from? The strength begets strength. I would not advise someone to go into Boeing, which is also in that group, both industrials and defense. So you want to look at the strength as a
very different looking chart.
Yeah, very different. And Boeing reminds me of CrowdStrike right now too. And CrowdStrike reported earnings as we tape this as well. I think it will take time. When you have a big crisis, a big event, it doesn't just snap its finger, come back. You have to really get your investors to get back on board. You have to have a track record of quarters where things go well. And I think stocks like a Boeing and a CrowdStrike, two different sectors, but they had crises, may take some time to come back. But getting back to your point, you go top down, you look at where the strength is, you skate to where the puck is, as Wayne Gretzky always said. And then, you go Michael Jordan, you take those shots. Well, I forget what his great quote is, but you want to basically look for strength and look at what's leading these sectors and be in that leadership, because those usually tend to do better. Now, I did the opposite with Pfizer. Healthcare is doing great. I'm looking for followers that could potentially catch up and play the dividend safe play. But, that's the approach. You look at the top down, what's performing, what's not, where you think your risk reward setups are. So from the industrials, you look at General Electric. In the healthcare stocks, the big guys, the Eli Lillys, the UNHs of the world. UNH, a great breakout this past summer. These stocks are the leadership. HCA, a stock that I liked at 300, it's at 390. I still like it. I want to be in these names. But when looking at different opportunities, I do want to anticipate breakouts. I've been wrong many times. As a technician in Ralph Acapora's class back in the day, you want to buy the breakout. You don't want to anticipate it. That's where the big money is. As a trader, forget that. I want to anticipate. This thing is going to break out, and I'm going to be part of it because that's where I can get an extra 2 to 5% if that's what the breakout is. But I know that I'm not confirming the trend, but I'm anticipating the trend to continue. And as someone that believes we're in a secular bull market, we may not be up the next 2 weeks, 4 weeks, 6 weeks, but I think over the next 3 months, 6 months, 12 months, in a rate cutting cycle, getting back to our Fed talk, in a cycle where I believe we're in the next secular bull, which will last 2 to 4 to 5 years, something like we saw in the late 90s, maybe not to that magnitude. We're off to a good start. Seeing leadership in technology, I still would want to be overweight technology stocks. Discretionary stocks not named Tesla, communication stocks, Meta, phenomenal stock. Netflix just broke out. That was one I almost brought to you. There's still strength in those big names, but what I'm seeing under the surface are opportunities, and I want to bring that to your audience as well.
Hey, we really appreciate it, Jay. And just as a reminder for folks, again, you can follow Jay at X, formerly known as Twitter, at JWoods3. And as he said, pinned right there at the top is some access to his weekly newsletter from Freedom Capital Markets. So you can kind of get his thoughts on a regular basis. And of course, hey, we're in a ever-changing market. So it's nice that you can kind of get that walkthrough on a weekly basis to kind of see where Jay is thinking now. So, hey, Jay, thank you so much for showing up on the podcast again. It was great having you.
It was great to be with you, Justin. You look great. Give Arusha my love, and I can't wait to join you again in the future. It's been fun. Awesome. And make sure you hit that like button, you subscribe, and you share this podcast if you like what you heard. So
great.
Give you a little plug on the way out as well, Justin.
Okay, and we'll see you next time, Jay. Thanks for being here. That's going to wrap it up for us this week. And next week, we're going to have Matt Caruso back on the show. Of course, the founder of Caruso Insights. Great to have him, a great educator. So I'm looking forward to that conversation. Thank you so much for being on and watching us this time around. And don't forget, at investors.com/podcast, you can get a lot more of these. You can actually see Jay's former appearance when we had him on a while back. So check out some of those, because some great lessons in all these podcasts. So thanks a lot for watching. We'll see you next time. Bye now.